following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Welcome back to NinjaTrader Live. I'll be your host of this segment, Tom Schneider, CMT. Kind of doing an extended version of Trader's Workshop today, a little bit different. It's my pleasure to welcome for the first time on NinjaTrader Live, Ophir Gottleib, who is the CEO of Capital Market Laboratories. How you doing?
I'm doing well, Tom. Thank you for having me, and hello to all of your NinjaTrader audience.
Thank you so much, Ophir, for coming on. We've had a chance to chat a couple times, and certainly learned a lot and want to learn more. But you're a man of multiple hats. I can see that, many hats. So if you can since your first time on here, if you could just give people a little bit of background of what you do and how you got, into the financial business. When did you start? What intrigued you? That kind of thing.
Yeah, absolutely. I got into finance officially in 1998. Started working for PaineWebber, which was acquired by UBS. And I've been in finance my whole life since. I'm a former option market maker on NYSE, ARCA, and SIBO, so that's my option trading hat. I'm a former hedge fund manager with a quant model, so I have a background in financial mathematics, computational mathematics, and a lot of AI published for that. So that was the fund, and that model was purchased, so the fund ended. The fund did great. Former managing director of quant research for an institution. And for the last 10 years, I've been running Capital Market Laboratories. And while we serve institutions, really my focus now is turned to retail investors. I've done the institutional side. It was great. But there's an information asymmetry. It's monumental. And that's what Capital Market Laboratories is designed for. So it's both, economic research and stock by stock research, and also for traders. We have something called Trade Machine, which is for option traders, hardcore swing trading with my AI layered on top of it.
I mean, fascinating background. You were an early AI adopter. The options background puts you in the top nth percent. In my mind, I'm impressed with options traders all the time, how smart you have to be to do that. And you may differ, from your experience, Ophir, but that's kind of the people I've worked with have always been really, really smart with options. And now, what's great about research is, you have that multiple kind of audience clientele type, right? You said institutions, I'm sure, in your wheelhouse because of your experience, but also retail traders can benefit from what you do.
Yeah, absolutely. So we have the top 600 institutions essentially in the world who are reading our stuff, but we also have tens of thousands of retail investors who, retail. It's interesting. One of the difficulties for retail traders, and I'm sure you know this with a lot of what you're dealing with, it's not just education and experience. It's actually time. I mean, there's a great disadvantage to being a retail investor because you have to live your life. You have to go to your job. You have to be a father or a mother or a brother or a sister or a friend. In institutional finance, we work 12 hours a day on the same thing. That already is an asymmetry. So I applaud all retail investors who are in this. Like, it's really, really hard if you're not doing this full time. I still don't fully comprehend how people do it without doing it full time, to tell you the truth. I know they do, and they do it successfully, but it's remarkable.
Right, and I would say starting in the business, in the institution side, 12 hours, they would get rid of you if you were only working 12 hours a day, right? I mean,
I meant 7 days a week.
Right, exactly. And you hear the horror stories, but there are good stories too. And you're right. I mean, retail, I don't know how many times when I was working with institutional traders and retail traders, you hear about the dentist who was trading between clients, and it's like, wow, you're committed, but you're right. It's a lot different from somebody who's focusing on one sector or part of one sector, analyzing and trading those markets.
It's profound. And the amount of information, or if we want to call it data, it's fine, that's coming in is I just don't understand how people do it without doing it full time, but they do. And you and I both know that there are millions of people who are doing this successfully as retail traders. And it's remarkable to me. Since I come from the other side, it's like, good for you guys. So,
well, you also probably had a fire hose, right, of
yeah,
information coming at you all the time.
nonstop.
And so you probably, I'm guessing you probably got very good at what to filter. And, the retail trader is kind of on the opposite end. They don't have a fire hose. They might not even have a hose, or they might not know where to go for the information. So that's why it's important to have somebody like you who knows both sides, right? Institution and retail.
Yeah, and be careful of disinformation. That's also insidious in a certain sense, right? You might have all of the best information. You get 2 bits that are not helpful, and it can just totally discombobulate. You had it, and now it's gone. So.
Right. So, Ophir, curious, this week, kind of a light week, kind of a light news week, and to me, the obvious big reports are PPI and CPI. But you said something interesting before the show. It seems like there's a lot more than just those 2 reports that could be the story, right? And it's like you're taking all these little stories and painting a bigger picture. So curious to hear your ideas about inflation that's coming out, but also the items we discussed before the show.
Yeah, I'm happy to. So you're right that as of for this week, it's July 8th, right?
Mhm.
There's the CPI, which is one version of inflation. And then there's PPI, which is wholesaler inflation. And neither of those 2 are what the Fed is supposed to be targeting. The Fed's supposed to be targeting another kind of inflation called PCE. But I think there's a broader story. I'll take a step back and you tell me if I take too far of a step back. Okay, Tom. The Federal Reserve has a dual mandate, which is just a fancy way of saying they're responsible for 2 things by the law. That's the law. It's governed by Congress. Okay, they call it price stability, which we can just call inflation. They're responsible for that. And they're responsible for full employment, which is a fancy way of saying the labor market. It's a dual mandate. There's 2 things. That mandate is not weighted. So one is not more important than the other, at least not in the law. We can sacrifice one for the other at times. For example, after the great financial crisis, we faced the risk of, we never faced it, we faced the risk of inflation with ZIRP to get jobs back, right? Okay, right now, maybe we're risking jobs in order to get inflation down. Okay, so it's a dual mandate. Just remember, even though everyone's talking about inflation now, in 2008, no one was talking about that. We're talking about jobs. Equally weighted. Okay, so what does that mean? What should the Fed be focused on if it's a dual mandate? Well, one of the portions of the mandate, price stability, aka inflation, is going very, very well. If you look at a chart of PCE, it's at multi-year lows. It's not quite at the 2% target. It's at 2.6, but it's down. And the trajectory is very far down. And economic trajectories, economic data is not like, they're not like stock indicators. It's not a minute, it's not a bar chart. It's not a minute by minute tick. Economic data, there's a reason they say that monetary policy works with long and variable lags. Turning around this company, this $27 trillion company we call the US, is very, very hard. So you don't look at it every day. Once a trajectory starts, it's very, very difficult to make the trajectory stop. And it's almost never happened that wherever the trajectory is, that it stops where we want it to. Okay, so I'm here to claim that inflation is moving in the right direction. Harmonized CPI, which is the way the rest of the world looks at inflation, which is using real-time markets, in the US has been at 2% for 12 months, and it's the same level it was in 2019, 2018, 2017, 2016, 2014. We're there and we've been there. That's one part. The other part is employment. Okay, this is what I see in the employment market and why I'm concerned. First of all, the unemployment rate is at the highest level in multiple years. Continuing jobless claims, multi-year high. Job openings, multi-year low. Credit card delinquencies, 7-year high. Savings rate, multi-year low. Real disposable personal income, the year-over-year change, low, dropping. GDP growth, dropping. Non-farm payrolls, cooling. It's a dual mandate. One of them is moving in the right direction. I believe has been at target for 12 months. One of them is seeing a rather alarming increase in the wrong way. I'm talking about the unemployment rate. So my argument and which it has been for a while, and we can go into the depths of what makes up PCE and CPI. That's fine. My argument is that it's time for the Fed to look at the other portion of the mandate. There's only two things. And if the Fed doesn't cut by September, I think that there should be a real discussion about whether Chairman Powell should still be at the Fed, right? That would be a congressional hearing, blah, blah, blah. But it's time to cut rates very, very soon. One portion of the mandate's working, well done. One portion of the mandate is getting very close to not.
Okay, so we've been talking about cutting rates, and even Mike Burke has been saying July. We should, why wait till September?
I agree.
July. But what other tools, or what tools does the Fed have to goose the labor market? Let's say, is it only changing the, cutting rates, or, is that the only thing they have in their toolbox to help along the labor market, or get it going in the right direction, let's say?
Or stop it from falling, which is really the only power they have. They can play around with their balance sheet, which has been contracting. Money supply has been contracting, and they can stop that. And I know there are a lot of people who feel very strongly that money supply in general is sort of, if you look at a chart of money supply and you look at a chart of inflation, they sure look like they're the same thing. One is driving the other. Since money supply is a choice and inflation is something we reflect upon, we receive it, then it must be the one that we have a choice on that should be driving it. Sure. I do not believe money supply, certainly in the United States, has any effect on inflation. And the reason I believe that is we saw 6 or 7 years of zero interest rate policy. They call it ZIRP, right? And a flood of balance sheet growing, massive balance sheet growth. And we just couldn't get anything going, right? It took to around 2015, 2016 to where people started finally saying, it's like 7 years after the bottom, people finally said, okay, I don't think we're going to go into recession anymore.
Right.
So I don't see that evidence. I do think that there's obvious correlation. You could show a chart and be like, this causes this. It's a lurking variable. It's a fancy word in mathematics. There's something else that's driving it, and it's a spurious regression, a spurious result, spurious regression. I won't get too technical. That's my belief. Having said that, to answer your question directly, hypothetically, the Fed could do what's called quantitative easing as opposed to quantitative tightening, and stop reducing the balance sheet.
I've heard that before.
Yeah, hypothetically possible.
That concept of it's easy to bring up two charts and say, aha, right, and they look the same, and aha. It's that causality. What is it? Causation is not
correlation.
What is that?
Correlation is not causation.
Correlation, right? Correlation is not causation, for sure. So there might be something related, is what you're saying, but it isn't necessary that money supply creates inflation. So, what's interesting is that unemployment rate, we see it in 1 month increments, right? Basically, what do they call it now? The employment situation. I'm sure you've known it as different names over the years, like we have. It's one of those things where the change isn't bad, right? I mean, if you look at it, 0.1% off, or a 0.1% growth, and it's easy for the talking heads, for whoever wants to spin it their way, to say it's not so bad, and really it's not so bad from month to month. But I think it's
not even statistically significant month to month, just so you know.
Right, exactly, right, and you think about, well, what a 4% employment rate, that's close to full employment. But I think what you're saying is the trend is in the wrong direction, and the Fed needs to get a handle on this.
Yeah. So Tom, here's the story I would tell. What everything you said was 100% true. 100% correct. If we take a snapshot of the economy and pretend everything stops, we just stop time, and you and I are talking, economy's looking pretty good. And an unemployment rate of 4.1%, really good. Prime age participation is remarkably strong, near all-time highs. People are in the labor force. The number of people who are taking second part-time jobs for economic reasons is finally going down. It was going up and getting worrisome, and it's not. It came down.
Okay.
Balance sheet of household sector, strong. Debt to income ratios falling for years. Debt to debt service ratios almost at record lows. Real wages are finally going up. Job creation is still happening. Net worth to disposable income close to record highs. Corporate sector similarly strong. Snapshot, absolutely. but we don't live in a snapshot. We live in trajectories, right? The trajectory is decidedly in the wrong direction for probably 5 of the most important measures of the health of the employment market. And economic data trajectory does not stop quickly. Just look at what happened with inflation on the way up, right? We couldn't stop it. We're like, just stop. And the Fed was raising and raising and raising. We couldn't stop it. It goes both ways, right? Yeah. So if we could just stop everything, oh, immaculate, amazing. Right. But we can't. And if the trajectory is in the wrong direction, then you look at what would be called the second derivative, the acceleration. You look at the trajectory of the trajectory. It's called acceleration. That too is going up. That's not great. It's time to pay attention to that.
So let's say somebody's watching this from the Fed, pretend, make believe, right? And they say, wow, Ophir is completely right. We're going to cut in September, right? They're not going to go far and say July. Let's say we get a second cut in December. Where do you think they will, do you have in your mind kind of a projection of where the cuts will get to, where they'll stop cutting, at what time? Like, are we going through 2025 with these elevated rates? Or is it, I'm just worried about the next cut?
Yeah, so 2 questions. And I think, so there is a fancy word for what you're asking. It's called R star. It's
Sure.
it's this mythical interest rate that's perfect equilibrium. Right. So the question is like, okay, what is R star? And how quickly do we get there? Nobody knows what R star is. COVID was the irritant. The further we get from the irritant, the less irritated we will be. Mm-hmm. Right now, what that irritant has caused is very, very tight monetary policy. I thought a Goldilocks 2024 was 2 to 3 cuts. I said that in September of 2023. At that time, the futures curve was showing 6 or 7 high cuts. People don't really understand futures curves. I know you do. That's partially speculation. So the market was actually probably expecting 5 or 6 cuts, not 6 or 7. So right. The market was expecting 5. Speculation, hedging doesn't count, and getting people to understand futures curves is impossible. So I'll just say it out loud. So the market was expecting 5. I thought that was too many. I thought that would be a total. If that happened, it wouldn't be like a kind of a recalibration of monetary policy. It would be like a wholesale change. We did not want that. Mm-hmm. Okay. We're still on that path, but I will tell you this. I speak with many CEOs. It's part of my job. Public companies, private companies. Small and medium-sized businesses are the core of what is driving the U.S. economy. Okay? It's not Apple and NVIDIA and Meta and Google and blah, 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 blah. There's a problem with small and medium-sized businesses that they have. And it's great when things are going well in the economy, and it's really bad when things are not going well in the economy. SMBs, small and medium-sized businesses, they can't pause. They can grow or they can shrink. It's a difficulty of being an SMB. When the economy is going well, that grow part is what keeps, that's our exceptionalism. We're entrepreneurs, whether it's technology or being a restaurateur. We're just economic exceptionalism. That's the good part of SMBs. The bad part of SMBs is with shrinkage. Because when we shrink, if we shrink too much, it's not that the Fed can just loosen monetary policy and, okay, Apple will hire more people. No, businesses go away, and in order to recover, we need new business formation. That's why it took so long to get out of the Great Recession. So that's our risk. So what does a cut do? Right? Your question was, okay, how many cuts, when, and how long does it last? From the SMBs I'm speaking to, I'm also speaking to a CEO who has 700,000 companies that are SMBs. Right? He has 700,000 customers that are SMBs. So I get this broader view.
Right.
They're really afraid that their cost of capital will go up. And that's a fancy way of saying that rates will go higher. Okay. If they receive a cut, it's not that 25 basis points, which is 0.25%, a 0.25% cut, is such a reduction in the cost of capital. But from the CEO, he's telling me the way they view it is, okay, if the Fed cuts, then my cost of capital isn't going to go up. Then I can invest and we can go back to the growth part. And that's why it's crucially important not to miss it. And it's okay if the Fed doesn't cut in July, probably. But they really got a signal in that press conference, like the ECB did and like the Bank of Canada did. Remember, there's already 2 cuts and their inflation is still falling. They signaled it incredibly well. It was just like the odds of a cut for the meeting before they cut it were like at 98%, right?
Right.
The Fed needs to communicate that in July. If they don't cut in July, say, hey, in September, it's looking really good like a cut. That will start to ease this sort of pessimism in SMBs, right? Remember, 43% of SMBs can't even pay their rent. Okay.
Yeah.
So I think we need 2 cuts. I think it'll be September and November or December. There might be 3. If there's 3 at this point, I think maybe something's gone wrong. So what's my Goldilocks? September, November, pause. September, December, pause. What is R star? Boy, I really don't know. It's not 5.25 to 5.5, which is where we are now. It might be 4.5. I mean, it might not be a whole lot lower. Let's say 1%, 100 basis points lower. Maybe R star is 4.25 to 4.5. I don't think our R star, our magical equilibrium rate, is back at 2.5%. There have been changes in the economy. COVID did change things, and there are long-lasting effects.
So Ophir, if you look back 50 years, that rate is about 4%.
Right.
Okay, on average.
Yep.
And you could talk about changes in the economy. 50 years, we saw a lot of changes a lot of times, right?
Yeah, off the gold standard, end of the Vietnam War, Iranian Revolution. I mean,
internet, right?
Yeah.
Exactly.
Yeah.
So, what it seems like is the longer we go without a cut, the harder it is for those SMBs to stay afloat for some of them, right? Because they're waiting to invest. They don't get that signal. And what happens? They're stagnant. Like you said, they can't really do that. They either thrive or fall off, right?
Yeah.
So the sooner we get that cutting signal, the more sure they can invest, right? And what would be really bad is if the Fed signals a cut, something changes and they raise hikes and you've just decimated the SMBs.
Well, I'll say this. How about this, Tom? So there's definitely a risk. We can't pretend there isn't a risk that cutting rates changes sentiment. That change in sentiment causes inflationary behavior. Let's say we can't say it's not a risk.
Right.
People pose this as though there's 2 choices, and I say there's 3. People say the Fed can cut or not cut. 2 choices: cut or not cut. 2 choices. No, the Fed can cut or not cut, or the Fed can cut and reverse. The third option is not a great option, but let us not pretend that it's not an option.
Right.
Now, you say, well, how bad is that third choice? Cut and then say, oops, and go back up. That option is not as bad as causing a recession. And that's the trade-off. The Fed isn't as handcuffed as people like to make it seem. And I hope the Fed knows that. I hope the Fed knows that.
Awesome.
This is a dynamic economy. The third option isn't ideal. You don't want to cut and reverse. It's better than a recession. And the risk of a recession is rising as continuing jobless claims hit multi-year highs, unemployment rate hits multi-year highs, job openings hit multi-year lows. So we have to pay attention to that, and don't handcuff yourself. You can reverse. It's not ideal, but you can. You can.
Yeah. Okay. Good. Ophir, this went way too fast, and I really enjoyed speaking with you. Where can people find you?
If you like the stuff that was coming out of my mouth about the economy, and you want to know, like, I follow 10 to 15 tech stocks, have for the last 8.5 years, and have an audited record that outperformed the S&P 500 and ARK and NASDAQ over 8.5 years. Just type CML Pro into Google. CML, that's Capital Market Laboratories, and the word pro like professional. CML Pro. You'll find it.
Awesome. Thanks so much again. And would love to have you back on. We'll figure out all of that. And wish you the best, Ophir.
I really appreciate it, Tom. Thank you.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.